Hello and welcome to a special episode for our portfolio recap. Today is January 1st, 2026, which means not only we're going to go over the month of December for 2025 and see how that went, but also do a little bit of recap on the entire year, do some introspection, see how everything went, and kind of our direction we want to move for 26. So let's just go through some of the numbers initially. We see we have our Roth IRA in Robinhood right here, $24,344.58. Now I got the 1 year chart up, and we can see that in 1 year, 19.67% gain, and that's $4,001 of profit. That number feels amazing. $4,000 of profit, and all I did was put the money into the account and just put in, broad market ETFs basically. I didn't have to do too much thinking about it, and I made $4,000. It's just a great feeling. So I want to reiterate that a little bit. Since we moved over to Robinhood, our all-time 32%, which is almost $6,000. Go shorter time frame, 3%. We're up 2.26%, a little over 500 bucks. 1 month we're down, so the month was basically trading down, and it was down a little more before this morning trading happened. So the actual month was down about 0.5% in the portfolio. The week is down 1%, $254. Normally we see like a Santa Claus rally going on in the stock market, but for some reason, just a bit of a pullback this year. So can't always bank on it. And then, yeah, obviously one day you can see we got overnight trading going on right now. So seems like tomorrow's starting a little higher maybe. Go over contributions first. Look at 2024. On here we had 2,900, which we'll actually see the numbers when we go over our stats. But 2025 we put $2,900, which is good. But this does not account for the fact that we're going to be actually depositing into this account until May 15th, which I think is the deadline. So yeah, we got about 5 more months that we can work with here. So plenty of time to still put contributions in. And we're trying to get this as close to $7,000 as possible because that's the max of it. I'll have videos coming out, but I did purchase a house. So clearly we're a little more, stringent on our funds, but nonetheless, we're going to try put our bonuses towards this and get that maxed out. But yeah, so our portfolio, we have a 60-40 split, 60% in QQQM, and then 40% split in VU. And then we can look at our stats over here. And then, yeah, we look at our portfolio. So we got a couple things here. We got our balance in green, what the SPY value would be if we were buying in SPY during that time in the blue, and our contributions in red. And we were pretty steady on contributions this year. And you see that we've been kind of steadily increasing the amount. It's pulled back a little bit during this home closing process, but nonetheless, it has been increasing still. Then we can go over here. We see our portfolio profit, and overall, we are up $8,800, $8,806. So that is great. You can see the trend line here is that it's going up, and it's going up at a near exponential rate. So that's great to see. Portfolio profit's been doing good. I mean, we can see things during the year like Liberation Day where it really pulled back on our portfolio profit. We were only up $3,800. I mean, that's crazy because that's a $5,000 difference than today. So you can see that even during those times like Liberation Day, kind of staying steady with our investment and our philosophy of just continually investing, even and especially when times are tough, it has proven well. And maybe during my home closing process, I could have stayed focused on that, but yeah, banks breathing down your neck a little bit, so you gotta stick with it. Look at our difference here. So whenever this value is negative, it means we were underperforming SPY or the S&P 500, and whenever it's above, it means we're outperforming SPY. Okay, so my approach is that yeah, we have 40% in VU, which is basically SPY, cheaper expense ratio, and then we have 60% in QQQM, which is QQQ but cheaper expense ratio, and it's primarily the NASDAQ 100, which is mainly tech stocks. And I think it goes without saying that this year tech stocks have shown out. They've outperformed the general market. A large amount of the S&P 500 gains actually come from those top 10, tickers inside the S&P 500. So that's a higher concentration of what we had. And we also had those tickers obviously in SPY. So we can see that we're outperforming the S&P currently by $655. And I mean, that's pretty good considering the fact that our portfolio is only 24,000 some. So that's basically just extra money that's going to compound over decades of being invested. And we'll have better metrics in the future tracking this as like maybe percentage of portfolio, how much are we outperforming. But we're going to consider just taking this at face value. We're doing great. Simply put, when this number is 1,000, I think I'll feel really good. Last month it was at 700, so we came back a little bit. Tech stocks kind of took a beating, and you can see that in stocks like Palantir and stuff this month. But nonetheless, I mean, yeah, it's just looking great, quite frankly. So if we look at our positions here of what makes up our portfolio, it's very, very simple, and I think my philosophy is that's how it should be. I do want to add some individual tickers into here, and I've been every month basically doing stock valuations to practice that muscle. And then also I can kind of reference where values end up in the future and see if my predictions and valuations are almost correct or fair enough to use. But for now, this is how simple it's going to be. So we got two positions, QQQM and VOO. Both of these are indice trackers respectively, but also very low expense ratios. So QQQM is just a cheaper version of QQQ, less trading volume, but doesn't matter for me, quite frankly. And then VOO is just like SPY, but its expense ratio is cheaper and tracks the same thing, basically the same performance within, point something 1 or 2 percentage, right? Something like that. So if we look here, we have our equity, our shares, cost basis, profit, and percentage change. QQQM, we have $14,777, cost basis of $177 per share, with 58.429 shares. And then VOO, $9,474 worth of equity, 15.108 shares, and a cost basis of $471.14. So QQQM makes up $4,428 of our profit, and VOO is $2,356 of our profit. So you'll see our overall profit over here, $8,807. This was as of yesterday. As of yesterday. You got our portfolio balance up here as of yesterday, which it's gone up like $90 more. Then you got our contributions total here. And this percentage it doesn't, factor in time in our contributions. So, I mean, nonetheless, 57% is great for the short amount of time I've been investing, but it doesn't account for the fact that I've kind of been investing more and more as of recently, rather than when I was starting investing. Then we just have kind of small positions here that we were kind of messing around with earlier in the year. Something I want to do continuing this year to see if I can make some good annualized returns. But yeah, I mean, Robinhood and CrowdStrike over here, we had great positions held for short times that I saw buying opportunities, and then Google, I held it. Obviously, it would have been worth it, but we'll talk about that when we go over some of these stocks in just a minute. But all this goes to say is that I'm trying to keep the portfolio very simple, and we've been doing that, and it's been paying off. We've been taking on higher beta just by having QQQM in the portfolio, but at the same time, it's not that much risk because we're tampering that down a little bit with S&P 500 just so stock swings and volatility that we're experiencing doesn't hurt the stomach as much as it probably would have otherwise. So I did kind of want to close off the year with just a couple notable stocks. So don't pay attention to any of these numbers on here for now. I don't got anything plugged in properly, and that's not what we're talking about. I mean, clearly we're not overvaluing NVIDIA by 700%. But let's look at some NVIDIA price data, and then we can go down here and look at the chart generated. So this is 10,000 days of NVIDIA stock. Realistically, it seems like it goes back to 2000, so 25 years of NVIDIA. And you'll see for 15 years of that stock price, it was just incredibly cheap. I mean, way back in here, yeah, it's not even trading at $1. It's a penny stock, more or less, right? And I think there's a good sentiment here, and kind of an overarching theme of 2025, 24, 23 is that innovation matters with these companies. And yeah, I mean, you can debate the ethical aspects of a lot of these companies, but you can't say they're not innovative at the very least. And we can see that innovation paid off for NVIDIA starting in 22, but primarily in 23 and beyond. And its stock valuation has just continued to rise. I mean, they're developing these GPUs for these major companies that need them for AI. I mean, they saw the innovation was on the forefront, and they were positioned to be the supplier for the innovation. So they're selling shovels in the gold rush, and it is great to see for them, but they're seeing more competition arise recently, You can kind of see that in the stock price. It's not just straight up like it was for a long time, and maybe I wish I was more invested in it at that time, right? But you can see that there's been pullbacks recently, and that, I mean, over the last 3 months, it hasn't actually performed the best relative to the market. But yeah, nonetheless, let's look at some of the valuations here. So you can see this light blue line is a standard deviation, and then we have a moving average that goes with it. So the relative standard deviation has actually held pretty steady. And that just means no matter how much it's swinging, you're seeing enough appreciation in the stock value where it's actually not that much volatility in comparison to the price. So that's pretty cool to see because, I mean, think about NVIDIA, you think about a high swinging stock. In reality, for the gains you're getting out of it, it seems like the deviation isn't actually that crazy. So that's one thing to look at. But also just look at these moving averages here. Like, it is just, even with the stock price, the moving average has just been really steady on it, which is great to see. It's just a steady constant performer, but I wouldn't be surprised if that isn't the truth going into the future. I mean, you can see where this orange one is the moving average for 200 days, and the black one is the moving average for 50 days. You can see that even they cross here sometimes. So sometimes there's some bullish indicators like early 23, but since 2023 where they're really taken off, it's only been bullish indicators before. This is a bearish indicator right here where it's slowing down. But since then, it's just been incredibly bullish, and the 50-day moving average has stayed above the 200-day moving average. So very incredible to see. Now, this is something I like to look at. I've been messing with it a little bit. I'm comparing the Sharpe ratio of NVIDIA to the Sharpe ratio of the S&P 500. So basically, all the Sharpe ratio is your return divided by the standard deviation. And it's saying like, okay, maybe I'm gaining more on something, but because of volatility I'm taking on, is it worth it? Okay. So the higher number this is, the better, because it either means higher returns or lower volatility. And both of those are great things. So bigger number, the better. You can see that we have the NVIDIA Sharpe ratio over time in the red, and the SPY, the market, in the black here. And there's been a lot of times where it's crossed. And that's very interesting because NVIDIA has, it's done incredibly well. And although, like we talked about, the volatility staying pretty, steady over here, it has high peaks. And those peaks are kind of causing this to happen. So if we look over here in the difference, anytime this is negative, it would actually make more sense with a risk adjusted basis to be buying the market rather than NVIDIA. So, I mean, you think of 2023, and you can see that steadily since then, yeah, it's just made sense to buy NVIDIA, and that's because the returns are so large, quite frankly, right? But all this time back here, if you're looking at a metric like this, up to 2015, there was a lot of times where it simply did not make sense to buy NVIDIA compared to the S&P because the returns compared to the volatility actually didn't make sense for it. I mean, you got like a whole almost like 2 years of where NVIDIA was relatively underperforming the SPY. So I think there's a little bit of a testament to see the gold buried in the dirt, right? Like NVIDIA really wasn't a big standout at that time. But I mean, if you were understanding AI and the early developments behind it, because the mathematics behind it has been around for a while, you could have actually positioned your investing portfolio in quite a good way and seen a lot of growth. So maybe I wish I was thinking about that in 2015. It's just some hindsight. Next stock I want to look at is Palantir. AI company has contracts with the government for defense and just kind of working with that. So nonetheless, I think it's maybe loading in here. Palantir has been a high flying stock as well. We've seen a lot of appreciation in it as of recently, so I kind of wanted to take a moment. It reminds me a lot of NVIDIA, basically. And you can see that although we have 10,000 days polling, that it actually only goes back to 2020. So this thing IPO'd, it seems, 5 years ago, and IPO'd at $10. And now it's currently trading, about like, I don't know, 180, somewhere like that, it looks like, right? So let's look at some of the numbers here. You'll see the deviation starts later just because how it pulls for a year. And the deviation for this has been pretty high, but not as high as something like NVIDIA. I mean, we were looking at like that 50% deviation. And although steady, that's still very high deviation. A deviation for this is actually fairly low, kind of around like that 30% ever since the beginning of 2025. But then, I mean, if we go back, we saw some relative high deviation at this point. But that's just because you were seeing swings and the stock price is also low. something that works in the favor of Palantir is, okay, the volatility has stayed pretty low, right? But at the same time, the stock price has also appreciated greatly, which keeps the standard deviation down. If you look at some of our indicators here, we have the, let's see, we have the moving average for 50 days in the black, and then the 200-day moving average in the orange. You can see that since, mid 2023, the short-term moving average has stayed consistently above the long-term moving average, meaning that that's a bullish indicator that it's increasing at faster and faster rates compared to what it's increased in the past. So great stuff to see from Palantir at that point. I think let's see. We can look at it later on another day because I think I'll do a valuation on Palantir, but it has a very high PE ratio, so basically people are expecting even a lot more growth. So although these numbers tell us a story, I think those numbers might tell you a different one. So we'll look at that another time and actually get into analysis. We'll look at here at the Sharpe ratios, right? So we talked about if it's above, well, the higher the better. So if the Sharpe ratio for the stock is higher than the Sharpe ratio for the market, it makes sense, right? So basically, we can see here that Palantir has been trading at a steady like 20 Sharpe ratio. And I don't know if that's correct for SPY. So yeah, I'm not sure if the SPY one's pulling correctly here, but nonetheless, you can see that it is just outperformed the market great when it comes in terms of the Sharpe ratio. So relative to the market, it's been doing great. It's been outperforming, it's been flying high, but I think in 2026 we're gonna have to look in terms of its PE ratio and see how its earnings are coming out to be. So let's try to pull some information for Google. Let's see how this one comes out. It's gonna take a couple of seconds to load. And Google's an interesting one because I actually purchased Google after maybe it was like a 10% dip or something like that. The market kind of hammered it out of nowhere. And I didn't really understand it. The PE ratio, it was great. It was in like the Magnificent Seven, so one of those great stocks is like relatively the cheapest one to buy in it. And at the same time, people were just hammering it and kind of almost discounting it and just not talking about it. It seems like everything else is getting attention, mainly Nvidia. But Google is also positioning themselves in terms of AI and innovation at the same time. And we can see that they're actually competing with Nvidia now by creating their own TPU chips rather than GPU chips. GPU is just more generalized. TPU is very specific, but specific for AI. And that's kind of what everyone cares about. They're buying GPUs because it helps with AI, but they're not buying it for other reasons. They're basically buying it for AI more or less. So, there's still a market for GPUs clearly, but Google, has been in talks with places like Meta about buying their TPUs. So they could actually position themselves into that market that NVIDIA has been comfortable in. If we look here, we know that Google has been in business for a while here, so we do have the full data. Going back to 2005 here, you can see that their standard deviation over time is pretty darn low. It's hovering below that 10% almost consistently. Sure, in 23 we had some higher deviation, but that mainly comes from the stock price coming down, it appears. So that's incredibly cool to see that you're not stomaching a large amount of volatility relative to the stock price. You can see that there are some crossovers between the 50-day moving average and the 200-day moving average. So anytime this deep black line is below the orange, that would be like a bearish indicator, and you have a long period of time here. You got April 22, and then like June of 23. So overall for that, you were seeing like a year of having a hard time buying Google. But then afterwards, after kind of 23, where all this AI came to the forefront, Google was obviously positioned in a great point in their company, so they were able to write off the back of that. But even here in like middle of the year, which we saw like a large drop in the stock price, and I think this is maybe where I bought it, we saw a bearish indicator on it, and people kind of were again discounting the stock. But you see as of recently, and maybe I should practice diamond hands and get some cojones rather than just selling it, but the stock price has appreciated greatly and it's just been flying up recently. So great for Google. Love to see that. It's a company I'm cheering for. I think they're some of the betters. And this is a mess if you look at this. That's very interesting. So it seems like the SPY actually pulled correctly for this one rather than the other. But you can see that it's all over the place. There's times where it seems like Google's a good buy and times where it's a bad buy. So it's very hard to actually time in a position. I feel like other stocks, like the last two we looked at, you can see how their Sharpe ratio was pulling. Then you see something like this, and you're like, wow, I don't quite know what point I'd like to get in. And I mean, if you look at it here, any point that this is positive means it was outperforming the market. Negative, it was underperforming on a risk-adjusted basis. You can see that it almost consistently hovers between above and below, above and below. So maybe that's just a testament to be like, hey, if you're interested in Google, you should be consistently buying maybe once a month or once every quarter and just making larger positions like that, because you can find valuation points like this where it's the stock is kind of flying up and down. If you see a dip, maybe you can, ahead of time just kind of do your buy then rather than kind of just consistently doing it on your normal schedule. So I think if you're interested in Google, just keep some money to the side. That's kind of what this Sharpe indicator difference is telling us. So I think those are the three stocks I mainly want to talk about for the year. I'm very happy with how our portfolio ended up, how these videos are turning out. I want 2026 to be more about individual stock valuations because I've had a little more passion with that and had a good time evaluating and streamline the process a little bit. But this Roth IRA is my bread and butter, and it's kind of what I want to stick with. And I have a lot of legwork here, so we're going to continue improving, continue working on having greater charts and better analysis so it's more digestible for the average person. This gets a little technical at times, but I think work on ways just introducing that to you guys so it seems a little more palatable. Nonetheless, thank you for tuning in. I always appreciate it. 2025 was a great year, and I have no doubt that 26 is going to be an even better year. Even if the stocks drop 30-40%, we've got a very good point in life, and we're going to just buy that up, get in a lower cost basis, and call it a day. So thank you again for watching, and I'll see you guys in the next one.